Hello, students, and welcome. Today, we are going to make the chapter Money and Credit super simple and, really memorable. Ready? Okay, let's dive into this. So, let's start with a big question. Just imagine, what if there was no paisa, no rupees? How would life even work? How would you buy, anything? Long ago, people traded goods directly for other goods. This system was known as the barter system. Simple, right? But it had a huge problem. Yeah, for barter to actually work, you needed this really tricky thing called a double coincidence of wants. It means what a person wants to sell is exactly what the other person wishes to buy. If the person with rice doesn't want your shoes, no deal. SHGs? It gets complicated really fast. This problem needed a hero, and you know what? That hero was money. Let's move on and see how this all builds up. So money acts as an intermediate step. It completely eliminates the need for that double coincidence of wants. Because of this really important job, we call it a medium of exchange. But listen, money didn't just appear out of nowhere. It evolved. It went from using things like grains and cattle to precious metal coins like gold and silver, and finally to the paper notes and coins we all use today. But wait a minute, why is a simple piece of paper so valuable? What's really interesting is that the paper itself has no value, but we all accept it. Why? Because it's authorized by our government and issued by the Reserve Bank of India, the RBI. It's legal tender. Okay, so now we have money. But where do people keep their extra cash? Under the mattress? No, that's where banks come in. Now, banks don't just hoard all the money you deposit. In India, they're only required to keep a small portion of their deposits as cash with themselves, which is about, you guessed it, 15%. And this brilliantly illustrates the bank's main job. They use the rest of that deposit money to give out loans to people who need it. And the difference between the interest they pay you and the higher interest they charge borrowers, that's how they make their income. Simple, but clever, right? These loans, which we also call credit, can be a huge, huge help, but they can also be very risky. Let's look at two very different situations to see what I mean. First up, meet Salim. He's a shoe manufacturer who got a massive order right before a big festival. To get it done, he took a loan. And for Salim, the loan was a total success. It helped him grow his business, make a good profit, and he paid it all back. So the crucial point here is credit really helped him. But now let's look at Swapna. She's a small farmer who took a loan for her crops from a moneylender, hoping for a great harvest. But then, disaster struck. Swapna just couldn't repay the loan. Her debt grew bigger, and eventually it forced her to sell her own land. She fell into what we call a debt trap. A debt trap is a truly terrible cycle. It's a situation where repaying a loan becomes almost impossible, and it just pushes the borrower into a worse and worse situation. It's the dark side of credit. So, how can someone avoid a situation like Swapna's? Well, it's all about understanding where and how you borrow money. It's about being smart. A key term you absolutely must know is collateral. This is basically a guarantee, like your land or a vehicle, that you give to the lender. If you don't repay the loan, they have the right to take it. So, loans mainly come from two sectors. First, there's the formal sector, like banks and cooperatives. They are regulated by the RBI and usually have lower interest rates. Then there's the informal sector, moneylenders, traders. They're unregulated and have very, very high interest rates. And just look at this data. In rural areas, the biggest chunk of loans comes from these informal moneylenders. That is a major, major problem and a big reason why people get stuck in debt traps. So what's the solution for the poor who often lack the collateral to get those safer formal loans? The answer is amazing. It's people helping themselves. Self-help groups, or SHGs, are just a brilliant idea. You have small groups, mostly of women, who pool their small savings together. This collection of savings allows them to get bank loans even without having any collateral. It's an incredible tool for empowerment. As the Nobel Prize winner Professor Muhammad Yunus said, giving the poor access to fair credit can unlock massive, massive development. It's not just about money, it's about potential. And that's a wrap on money and credit. I really hope this explainer was super helpful for you. To really master this chapter, make sure you check the description below for important questions, a mind map, and your complete exam kit. And hey, don't forget to like, share, and subscribe to our channel. See you next time.